In 1933, the U.S. government executed a massive gold confiscation, only to revalue the metal 69% higher 9 months later. During the 1930s, Germany seized gold reserves to fund its aggressive war machine. In 1966, Britain imposed a strict 5-year ban on gold ownership. Throughout the 1960s, France repeatedly introduced severe restrictions on gold. Australia banned private gold ownership for 17 years starting in 1959. India went even further in 1962, criminalizing gold ownership for 28 years. Italy requisitioned gold for the war effort in the 1930s. Japan confiscated gold in the 1940s just before hyperinflation obliterated the yen. That's 8 countries and 8 distinct acts of confiscation, every single one adhering to the exact same 4-stage pattern. Astonishingly, right now in 2025, all 5 of the critical triggers that historically preceded these 8 confiscations are aligning once more. Consider the immediate evidence: the U.S. national debt has ballooned to $36 trillion. The petrodollar system, the bedrock of global U.S. currency dominance, effectively ceased in June 2024. Central banks globally acquired over 1,000 tons of gold in 2023 alone. Military spending now exceeds $1.5 trillion annually. Regional banks are showing serious signs of failure, and most telling, gold has spiked 59% in 1 year to reach $4,200 per ounce, while silver has surged an even more dramatic 86% to 96% in the same period, hitting $60 to $64 per ounce. These are far beyond normal market movements, they are flashing red crisis indicators. When precious metals spike simultaneously and at this unprecedented pace, history confirms what inevitably follows: aggressive government intervention. However, the government will not repeat the physical gold seizure of 1933. Instead, they will deploy 4 highly sophisticated modern mechanisms designed to trap your wealth before you even realize the system has closed around you: central bank digital currencies, CBDCs, that possess the power to reject gold purchases outright. Capital controls that can instantly freeze access to your bank account. Bail-ins that allow the outright confiscation of your bank deposits. Punitive taxes that render the ownership of physical gold financially unsustainable or practically impossible. The recurring pattern has manifested 8 times within the last century. The 4 stages are currently beginning to form, and the parabolic price movements are confirming this ominous forecast. We will now examine every major gold and silver confiscation in modern history, the exact 4-stage blueprint that repeats universally across all cases, the 5 pre-confiscation triggers, why gold at $4,200 and silver at $60 to $64 are signaling the precise warning that flashed before every previous seizure, and the specific digital mechanisms governments will utilize this time to trap your wealth without ever having to physically touch your gold holdings. Understanding this phenomenon is not about mere market prediction, it is about recognizing an inviolable pattern that has successfully repeated 8 times over the last 100 years. And escaping this pattern may prove impossible, as the necessary triggers are already manifest, the stages are actively forming, and the mechanisms of control are currently under construction. Before we analyze the 8 historical cases in depth, it is essential to grasp the fundamental motivation behind why governments confiscate gold and silver. When citizens securely hold these precious metals, they possess assets that operate entirely outside of government monetary control. Gold cannot be printed, and silver cannot be debased. However, when governments face catastrophic debt crises, they resort to printing massive amounts of money, which inevitably causes inflation. If citizens are free to flee into gold and silver, they successfully evade this inflation tax. Thus, governments must seize these metals to eliminate all viable alternatives to the government-issued fiat currency. Every single act of confiscation adheres precisely to 4 stages. Economic crisis creates the necessary public justification. Private ownership is officially criminalized. Citizens are forcibly compelled to sell their metals far below true market value. The government dramatically revalues the metal and uses this new valuation to inflate the currency supply. 4 stages, 8 countries. The same identical pattern, every single time. It was April 5, 1933, 8 a.m. A bank manager in Cleveland unlocks his doors to find an official government notice posted overnight, Executive Order 6102.
The mandate was absolute. All persons were required to deliver all gold coin, gold bullion, and gold certificates to a Federal Reserve Bank by May 1, 1933. By 9 a.m., the phones were ringing off the hook. By noon, a frantic line had formed outside, people arguing in disbelief with the bank tellers. Americans were given exactly 26 days to surrender their gold holdings. The price offered, a non-negotiable $20.67 per ounce. Refusal meant facing up to 10 years in federal prison plus a $10,000 fine, an amount equivalent to $230,000 in today's currency. This was law, enforced with the full power of criminal prosecution. 9 months later, after Americans had complied and surrendered their gold at $20.67, the government instantly revalued it to $35 per ounce, a 69% overnight increase. The government had forced its citizens to sell at one price, only to immediately declare that the gold was actually worth 69% more. This remains the single largest, deliberate wealth confiscation in American history, and it perfectly followed the pattern that would repeat 7 subsequent times. The crisis began with the 1929 stock market crash, culminating by 1933 with 9,000 bank failures and unemployment reaching 25%. The entire banking system faced total collapse. Since the United States was operating on a gold standard, meaning every dollar was theoretically backed by gold at $20.67 per ounce, convertible on demand, Americans, having lost faith in banks and paper money, began demanding gold. This capital flight drained the banking system. Had everyone converted their dollars, the Treasury would have emptied, leading to a complete dollar collapse. This is stage 1, economic crisis creates the justification. Gold confiscations never occur during periods of stability, they happen during severe crises when the government needs an urgent public justification. While the government officially framed the seizure as necessary to stabilize the banking system, the real reason was far different. The government desperately needed to confiscate the gold so it could print money without the restrictive constraint of the gold standard. On March 6, 1933, President Roosevelt declared a national banking holiday, immediately closing every bank. Citizens were denied access to their money for 4 days. Then, on April 5, 1933, Executive Order 6102 was issued. This is stage 2, the government criminalizes ownership and compels surrender under threat of prison. Gold hoarding was instantly made illegal. The penalty for refusal, 10 years in prison and a $10,000 fine, was intended to ensure compliance through abject fear. Suddenly, law-abiding citizens were turned into criminals overnight. The gold they had legally acquired and held for decades was now illegal contraband. Exemptions were minimal as citizens could keep up to $100 in gold coins, about 5 ounces, plus gold used in industry or rare coins. The $100 exemption was deliberately negligible, it allowed pocket change but forced the surrender of any meaningful savings. The penalty was extreme. $10,000 in 1933 is equivalent to $230,000 today. The Treasury reported that 21.9% of privately held gold was turned in, over 300 tons were confiscated. While many people successfully hid or shipped their gold overseas, the majority complied. You went to a Federal Reserve Bank, had your gold weighed, and were paid $20.67 per ounce in paper dollars. You walked in with physical gold, real money, and walked out with a paper promise from the government. This is stage 3, the government never pays fair value, it pays a price it arbitrarily determines. 9 months later, the government revalued the gold it had acquired for $20.67 to $35 per ounce. If the government truly believed gold was only worth $20.67, why would it instantly revalue the metal to $35 9 months later? Because the forced sale price was deliberately below market value. Citizens received $20.67, the government valued it at $35. That is not fair compensation, it is, undeniably, theft. This is stage 4, after confiscating gold, the government revalues it higher. The Gold Reserve Act transferred ownership of all monetary gold to the U.S. Treasury and revalued it from $20.67 to $35 per ounce, a decisive 69% increase. By revaluing the gold, the government gained much more than just wealth, it gained the unrestrained power to print money.
Before 1934, every dollar had to be backed by gold at $20. After the $35 revaluation, that same amount of gold could back 69% more currency. In effect, the government increased the money supply by 69% without acquiring any additional physical gold, a form of monetary expansion by executive decree. Since Americans could no longer legally own gold, they had zero protection against the severe inflation that immediately followed. From 1934 to 1945, the U.S. government drastically increased the money supply to finance the New Deal and World War II. If you had held gold, you would have been protected. Instead, you were forced to hold depreciating paper dollars that lost value every year. This is the established mechanism: seize the gold, revalue it higher, print money against the new valuation, inflate the currency, and transfer massive wealth from citizens directly to the government. This mechanism worked flawlessly in the United States in 1933, and it repeated in 7 other countries using the exact same 4-stage blueprint. Germany. After World War I, Germany faced crippling hyperinflation. When the Nazis seized power in 1933, they desperately needed funds for rearmament. Stage 1, the economic devastation of the Treaty of Versailles, the ensuing depression, and the pressing military buildup provided the crisis. Stage 2, the Nazis mandated that all citizens surrender their gold, specifically targeting Jewish citizens for seizure. Stage 3, gold was surrendered at government-set prices, drastically lower than international rates. Stage 4, the confiscated gold directly financed German rearmament and the subsequent war. By 1939, an estimated 90 tons of gold had been seized, resulting in a total loss for citizens. Same 4 stages, different country. Britain. Post-World War II, Britain was financially bankrupt, and the pound sterling was rapidly losing value. Stage 1, the necessity of currency defense against collapse. Stage 2, the Exchange Control Act was used to ban all private ownership of gold bullion. Stage 3, citizens were compelled to sell their holdings to the Bank of England at government-controlled prices. Stage 4, in 1967, Britain devalued the pound by 14% overnight. The restriction lasted from 1966 to 1971. When ownership was re-legalized in 1971, gold was $35 per ounce. By 1980, it soared to $850. Those blocked from owning gold missed a 24-fold increase in wealth. Same 4 stages. France. France experienced multiple confiscations. Stage 1, repeated fiscal crises and financial instability. Stage 2, laws were passed requiring citizens to deposit their gold in banks. Stage 3, gold deposits were converted into francs at rates fixed by the government. Stage 4, France devalued the franc multiple times, 1928, 1936, 1958. Citizens holding francs saw their purchasing power destroyed. Same 4 stages. Australia. Gold ownership was banned from 1959 to 1976. Stage 1, post-war reconstruction and pressure on the currency. Stage 2, the Banking Act strictly prohibited private ownership without explicit government permission. Stage 3, citizens were required to sell to authorized government dealers. Stage 4, the Australian pound was devalued repeatedly. This 17-year restriction prevented Australians from participating as gold surged from $35 to over $100. Same 4 stages. India. Stage 1, severe balance of payments crisis. Stage 2, the Gold Control Act of 1962 severely restricted private ownership. Stage 3, citizens were required to declare their holdings, and possession beyond set limits was criminalized. Stage 4, the rupee was drastically devalued multiple times, 1966, 1991. Although the act was repealed in 1990, decades of restrictions had prevented Indians from using gold to protect their familial wealth. Ironically, after liberalization, India became the world's second-largest gold consumer. Same 4 stages. Italy. Stage 1, the need to finance the Ethiopian invasion and World War II. Stage 2, initial gold for the fatherland voluntary campaigns were followed by mandatory requisitions. Stage 3, gold was surrendered in exchange for government bonds that rapidly became worthless.
Stage 4, following World War II, the lira currency completely collapsed. Same 4 stages. Japan. Gold was confiscated during World War II. Stage 1, financing the devastating war effort. Stage 2, the government required all citizens to surrender their gold holdings. Stage 3, gold was exchanged for yen at government set prices. Stage 4, after the war, hyperinflation entirely destroyed the value of the yen. By 1946, prices had increased 40-fold. Citizens who surrendered their gold lost everything, only those who successfully hid their gold survived. Same 4 stages. 8 countries, 8 confiscations, all adhering to the same 4 stages every single time: the United States, Germany, Britain, France, Australia, India, Italy, and Japan. Despite vastly different political systems and spanning several decades, the mechanism, the pattern, and the result remained identical. Economic crisis creates justification, ownership is criminalized, citizens are forced to sell below market value, the government revalues the metal and inflates the currency. This results in an inevitable transfer of wealth from the citizens to the government. This is the pattern. It does not change because, from the government's perspective, it works. It worked 8 times over 50 years. And now, the pattern is aggressively reforming because the precise preceding triggers are present once more. 5 distinct triggers consistently appeared before historical confiscation events. First, unsustainable government debt, present in 7 of 8 cases. Second, currency under extreme pressure, present in 7 of 8 cases. Third, capital flight, present in 6 of 8 cases. Fourth, war or high military spending, present in 5 of 8 cases. Fifth, banking system instability, present in 4 of 8 cases. Across the 8 historical cases, these 5 triggers were dominant. Now, in 2025, all 5 triggers are present and accelerating. The U.S. national debt currently sits at $36 trillion, translating to 129% of GDP. The Congressional Budget Office projects this will hit $50 trillion by 2034, 180% of GDP. Annual interest payments alone are $900 billion, projected to rise to $1.6 trillion by 2034. This level of debt far exceeds the justification levels of 1933, when the debt-to-GDP ratio was just 40%, today, it is 129%. The first trigger is present. The Petrodollar agreement formally ended in June 2024, meaning Saudi Arabia is no longer obligated to sell oil exclusively in US dollars. Furthermore, BRICS nations are rapidly constructing alternative payment systems designed to bypass the dollar entirely. Central banks globally bought 1,037 tons of gold in 2023, systematically diversifying away from dollar reserves. The second trigger is present. Wealthy Americans are increasingly moving assets offshore. U.S. citizens renouncing citizenship hit record levels in 2023. Purchases of physical gold and silver have surged dramatically, with dealers reporting chronic inventory shortages and high premiums over spot prices. The third trigger is forming rapidly. Official U.S. defense spending is $870 billion, but when including veterans' benefits, nuclear weapons upkeep, and intelligence operations, it exceeds $1.5 trillion. Aid to Ukraine totaled $75 billion in 2022 to 2023, and Israel receives $3.8 billion annually. Military spending is at Cold War levels. The fourth trigger is present. In March 2023, Silicon Valley Bank, Signature Bank, and First Republic all collapsed within weeks. Commercial real estate now faces a profound crisis, with $1.5 trillion in loans maturing between 2024 and 2026, many of which are underwater. Regional banks hold 70% of this commercial real estate debt, making widespread failures highly likely between 2025 and 2027. The fifth trigger is forming. All 5 triggers, present across 8 historical confiscations, are now either fully present or rapidly forming. The underlying conditions precisely match those that preceded every prior seizure, and the volatile price movements in precious metals are confirming this grim reality. Gold is trading at approximately $4,200 per ounce,
having risen about $1,260 over the last year, a staggering 59% increase in just 12 months. Silver, meanwhile, is trading between $60 and $64 per ounce, surging $29 to $33, an explosive 86% to 96% increase.
These are not routine market movements. They signal deep systemic distress.
A 59% move in a single year is historically rare and signals for immediate dangers: massive currency devaluation concerns, systemic financial crisis fears, spiking inflation expectations, and a profound loss of confidence in paper assets.
All four conditions are present right now.
Silver's 86% to 96% increase is even more significant. Historically, the gold-to-silver ratio averages 60 to 1. During crises, it can plummet to 30 to 1 or even 15 to 1. If the ratio merely reverts to 40 to 1 with gold at $4,200, silver would immediately hit $105. If it hits 30 to 1, silver would be $140. This rapid, simultaneous rise in both metals confirms that smart money market participants are aggressively shifting out of paper assets and into hard assets, signaling preparation for dollar devaluation, a banking crisis, a sovereign debt crisis, or ironically, the explicit expectation of future confiscation. In 1933, gold was confiscated immediately after it experienced a panic spike, hitting $20.67, before being revalued to $35. The government deliberately waited until prices were high enough to justify the necessity of an emergency intervention. Current prices approaching $4,200 may trigger similar authoritarian thinking. History consistently demonstrates that significant price spikes precede decisive government action.
When prices spike due to systemic crisis, governments intervene. We are currently in the spike phase.
The triggers are present. The price movements confirm it.
And the new mechanism is being constructed.
However, the government will not try to replicate 1933. Physical gold ownership is now far too decentralized. Instead, for sophisticated modern mechanisms will achieve the precise same outcome: confiscation of purchasing power without ever physically seizing your gold.
First mechanism: punitive taxation and reporting. Gold is currently taxed as a collectible at a 28% capital gains rate, higher than the standard 20% stock rate. The government could easily hike this rate to 50% or 70%.
They could impose annual wealth taxes specifically on gold holdings. They could mandate immediate, real-time IRS notification for all purchases, and require the registration of all private holdings. This approach does not confiscate the metal, but makes ownership so costly and heavily surveilled that the vast majority of citizens will not bother.
Same result, different mechanism. The second mechanism: central bank digital currencies, CBDCs. CBDCs grant governments unprecedented programmable control over money.
Your digital wallet could be programmed to reject gold purchases outright, impose an automatic 90% tax on precious metals transactions, flag any account attempting to buy gold, or restrict conversion into gold-backed stablecoins.
China's digital yuan already possesses these capabilities. Europe's digital euro launches in 2026. The US is actively researching a digital dollar.
Once implemented, the government never needs to confiscate gold, they simply make buying it impossible via CBDCs. Same result, different mechanism.
Third mechanism: capital controls.
During severe crises, governments impose strict limits on cash withdrawals, restrict international transfers, prohibit the purchase of foreign currencies, and ban the buying of gold above certain minimal amounts. If the US faces a severe dollar crisis, similar controls will follow, trapping your money inside a failing banking system, making conversion to gold impossible.
Same result, different mechanism. Fourth mechanism: bail-ins.
This official policy, implemented in the US, EU, and numerous other countries, converts depositor funds into bank equity when banks fail. If your bank collapses and you have $500,000 in deposits, you could instantly lose 40% to 60% of that money, receiving nearly worthless bank shares in return. This mechanism confiscates your cash deposits before you ever have the chance to convert that cash into hard assets like gold.
Same result, different mechanism.
These four mechanisms collectively achieve the exact same outcome as the 1933 seizure without requiring the government to physically touch your gold. They trap wealth firmly in paper assets, render gold ownership impractical, prevent the critical conversion from paper currency to hard assets, and enable the government to inflate the money supply without citizen escape. The timeline is rapidly converging, 2025 to 2027, commercial real estate defaults and regional bank failures escalate. The government immediately implements capital controls and bail-ins. 2026 to 2028, Europe launches the digital euro, 2026, the US likely follows, 2027 to 2028. CBDCs become fully operational. 2028 to 2034, US debt reaches $45 to $50 trillion. Interest payments exceed $1.5 trillion. The government faces the choice between default, severe austerity, or massive inflation. If inflation is chosen, punitive taxes on gold are implemented to prevent citizens from escaping. Post-2034, the Congressional Budget Office projects debt becomes unsustainable. Something catastrophic breaks. The dollar loses reserve status, followed by debt restructuring or hyperinflation. Gold and silver are either heavily restricted or dramatically revalued higher. Historical precedent strongly suggests that these restrictions arrive during the peak of the crisis, not after it subsides. The 1933 confiscation occurred in year 4 of the Great Depression. The government waits until the crisis is severe enough to justify sweeping emergency measures. Current conditions suggest intervention between 2026 and 2028. When it hits, the 4 stages will repeat seamlessly. Stage 1, the crisis, banking failures, commercial real estate collapse, dollar losing reserve status. The government frames emergency measures as necessary for survival. Stage 2, criminalize alternatives, CBDCs prohibit gold purchases, capital controls prevent gold imports, mandatory reporting tracks every single transaction. Stage 3, trap wealth in paper, bail-ins, bank freezes, withdrawal restrictions. The government proactively prevents the conversion of paper wealth into hard assets. Stage 4, devalue currency, the government inflates the debt away via unrestrained money printing. Your dollar-denominated assets lose purchasing power while the government's real debt burden magically decreases. For stages, the same pattern, achieved through new mechanisms, and you cannot escape because the technological system is being built to fully encompass you. In every historical case, the people who successfully preserved their wealth did 2 essential things: they recognized the pattern early, and they held physical assets outside the banking system. Gold hidden at home, shipped overseas, or placed in private vaults survived confiscation. Those who lost wealth trusted the government, kept their assets in banks and paper instruments, and complied with confiscation orders. In 1933, citizens who turned in gold at $20.67 and held dollars lost 40% when gold was revalued to $35, and then lost even more to inflation over the next 40 years. Conversely, citizens who illegally kept their gold saw it rise from $35 in 1971 to $850 in 1980, a 40-fold return from the 1933 confiscation price. The same precise pattern holds across all 8 cases. Those who recognized the danger early preserved their wealth, those who complied lost everything. The confiscation pattern always targets the very asset you are using for protection. When you buy gold to escape inflation, the government restricts gold. When you move money overseas, the government imposes reporting requirements. When you try to opt out of the banking system entirely, the government creates CBDCs, making opting out functionally impossible. The system is designed to trap you at every single exit point. The confiscation pattern is ultimately not about gold, it is about preventing escape. You see it in the CBDC pilot programs launching in 2026. You see it in the 2023 banking failures that went unpunished while depositors lost access. You see it in the $36 trillion debt that can never realistically be repaid. You see it in gold spiking 59% and silver surging 86% to 96% in 1 year. You see it in central banks buying 1,037 tons while simultaneously telling citizens that gold is a barbarous relic. The pattern is fully forming. The triggers are present. The mechanisms are being built. And the price movements confirm what history demonstrated 8 times before: when governments face debt crises they cannot solve through austerity or taxes, they solve them through forced confiscation and inflation.
8 times in 8 countries over 50 years, the United States 1933, Germany 1930s, Britain 1966 to 1971, France 1930s and 1960s, Australia 1959 to 1976, India 1962 to 1990, Italy 1930s to 1940s, Japan 1940s. For stages every single time. Same pattern. Same result. The outcome is always the same, a massive transfer of wealth, moving from citizens holding devalued currency directly into the hands of governments who hold revalued gold. Fast forward to 2025, we find ourselves facing $36 trillion in debt, the petrodollar system is crumbling, central banks are accumulating gold at an unprecedented pace, military expenditures have surpassed $1.5 trillion, banks are showing signs of systemic failure, and the price of gold has soared 59% to $4,200 per ounce. Crucially, all 5 historical triggers for confiscation are now simultaneously present. This repeating pattern isn't driven by malice or ideology, it is mathematically compelled. When sovereign debt breaches 180% of GDP, when annual interest payments balloon to multi-trillion-dollar figures, and when the dollar finally loses its global reserve status, the government is left with only 3 stark choices. First, they can default, which would instantly crash the entire financial system. Second, they can impose crippling austerity measures, inevitably plunging the nation into a deep depression. Or third, they can choose inflation and confiscation, a calculated maneuver to transfer the entire burden of debt from the government's balance sheet onto the backs of its citizens. History unequivocally demonstrates their preferred course of action. Governments invariably choose inflation and confiscation because it is the path of least political resistance. The public remains largely unaware of the transfer until the process is complete. By the time the average person realizes their wealth has been systematically confiscated through monetary inflation, currency devaluation, and restrictive policies, the window of opportunity has closed. This is not a conspiracy theory, it is the confiscation pattern, a documented historical phenomenon that has repeated 8 times and is actively forming once again in our present economy. Whether you acknowledge it or not, you are currently operating within this pattern. Look at the indicators: gold at $4,500, silver ranging between $60 and $64, demonstrating year-over-year gains of 59% and nearly 96%, respectively. These are not merely market prices, they are unequivocal warning signals. The global market has already priced in what is coming. Smart money is strategically positioning itself, and central banks are aggressively acquiring physical assets. Meanwhile, the average retail investor is still clinging to paper assets, tragically believing that the government will somehow protect them from the inevitable crisis. This is the exact same misguided belief held by Americans in 1933 when they surrendered their gold at $20.67 per ounce, the same belief that led Germans to exchange their gold for worthless Reichsmarks, the same belief that caused the British to accept punitive financial restrictions. This fatalistic trust has preceded confiscation during every single one of the 8 historical occurrences. The pattern is indifferent to your personal beliefs. It is driven purely by mathematical inevitability. And mathematically, our current situation is identical to the prelude of 1933. We have unsustainable levels of debt, currency under severe pressure, accelerating capital flight, exploding military spending, and profound banking instability. 5 critical triggers are present. 4 distinct stages of confiscation are currently forming, and the regulatory mechanisms are actively being constructed. When Stage 2 begins, when restrictions are implemented, when central bank digital currencies, CBDCs, launch, when strict capital controls are imposed, when gold purchases are flagged, and when bail-ins confiscate your deposits, you will inevitably ask the very same question asked 8 times throughout history. That question is, why didn't anyone warn us? The warning is inscribed within the pages of history. 8 countries, 8 confiscations, 4 established stages, 5 concurrent triggers, all present now. Price movements confirm this unfolding crisis, with gold soaring 59% and silver spiking 86% to 96%. The market is not whispering, it is screaming about what lies ahead. You have a critical choice to make. It is not about escaping the pattern, because you cannot escape a systemic collapse designed to trap every exit.
Your choice is whether you choose to see this pattern before restrictions are fully implemented or after the fact, whether you position yourself before stage 2 or desperately try to react during stage 4, whether you become the person who shrewdly hid their gold in 1933 and realized a 40x return by 1980, or the person who complied, instantly losing 40% of their wealth, followed by decades of crippling inflation. The confiscation pattern has repeated 8 times in the last century. The stages are visibly forming, the triggers are fully present, and the dramatic price movements confirm the impending crisis. The only relevant question remaining is whether you will proactively see this coming or whether you will be left asking why no one warned you. When gold purchases are restricted, bank accounts are suddenly frozen, and your paper wealth is inflated into oblivion, all while the government revalues its own gold reserves at $10,000 per ounce and insists that these actions were tragically necessary to save the economy. 8 times, it is the same pattern, the same devastating result, and the same fundamental choice: see it early or see it too late. The pattern itself is immutable. History does not stop repeating. And this system, designed to ensnare your wealth, is being constructed around you right now. If this analysis has illuminated a pattern you had never previously recognized, if you now truly understand that gold at $4,200 and silver at $60 to $64 are not mere trading prices but profound warnings, if you clearly see that all 5 triggers identified in 8 historical confiscations are present once more, then subscribe. The next discussion will detail the other types of assets governments seize during a crisis, extending far beyond just gold and silver: real estate through massive property tax hikes and eminent domain, bank deposits through institutional bail-ins, retirement accounts through mandatory government bond investments, and cryptocurrencies via aggressive exchange controls. The established confiscation playbook is universal and applies to virtually all asset classes. 8 documented countries prove this pattern exists. Current economic conditions prove it is repeating right now. Price movements confirm the market recognizes the danger. The only unanswered question is whether you recognize it, too. The confiscation pattern, 8 times in history, for defined stages every time, 5 triggers all present now, and a system being deliberately constructed to trap your wealth, without you noticing until everything is already lost. Welcome to the pattern. You are already inside it.